Round 4P review. Again, hopefully these will continue to go a little quicker as you guys get a little better understanding of this. I'll try to hit on some big points and maybe show some things that I look at, and hopefully will get you guys kind of looking in that same direction. So I would start off this way, and while it's interesting to note we had some big winners in terms of sales, Erie and Ferris, Chester too. We also had a couple teams, Baldwin and Digby in particular, whose sales really kind of faltered, and so I kind of want to know why. And let's look at that first, because that's something that would grab me. Why did Digby only have $82 million in sales? Still made a little bit of money actually, but only $82 million in sales. Well, I'll come down first to the production. Okay. Sorry, I gotta scroll on down here, but we come down to the production, and I want to know, well, maybe they didn't make as much as other teams. And while it's true that they were toward the bottom, it made as much product. We're looking at the gold one here. Made as much product as Andrews Baldwin. Baldwin didn't have very much in sales either. But it made as much as either of those, and really not that much less than, say, Chester, quite a bit less than Ferris, obviously. But the point is, that makes me think then that it must have some inventory. Okay, and so I scroll down a little bit further and I look, oh my goodness, right? Sold out in the low end, did not sell well in the high end at all, sold out in performance and size. And so, then I ask that question, well, why didn't it sell very many? It sold very few in the traditional segment. Okay, and sometimes I can tell, right from this report. Let's compare it to cake, for example. Cake sold 22.8 million, right, versus 248,000. So what was the scoop there? Well, ooh, look at that price, $3 difference. Okay, that might be a problem. The location, the performance here is higher, okay, and the size is lower, so I'm going to assume it's better positioned. Age is a huge factor in the traditional segment, okay, and so Team Digby's sitting here at a 7.1, way old, right, way old, when in the traditional segment, ideal buying age is 2, right, price, so it's priced at the top of the range, and its performance and size are well, we can probably see it on here. Its performance and size, where is Digby's? It's way back here. Okay, it's about ready to fall out, and that may be planned. Okay, that may be planned. Maybe a life cycle thing where that's going to go into the low end. Maybe that's where it needs to be, but then it has to compete with the low end. Okay, and price-wise, it's way out of reach for those low-end customers. We'll take a look. The highest price on the low end is $23, and if we're at 28, I think if you look in your guide, you'll see if you're more than $5 over or $5 or more over, it just won't sell there. So days, maybe sold a few items here. We'll see. No, it doesn't show it as selling any items in that category. It's positioned there. That's what it's telling us on the perceptual map, is that it's positioned there, but it didn't sell any, and that would be because of the price. Okay, so break those things down. The high end's probably going to be something. Sorry, again, I'm scrolling around, but the high end for Digby also didn't sell. Okay. Only sold 99 units and had 838. My guess, again, if this thing's maybe using a life cycle, it's probably moving towards the traditional segment, and again, maybe didn't make the adjustments that are necessary, especially in the price side. Okay, so depending on the strategy there, those strategies can be very effective and they can work, and you don't spend a lot of money on R&D, and those things are kind of good. Okay, but you still have to be wary of some things like price, obviously. Okay, you also have to still be wary of age. Okay, so even if this is in the traditional segment, its age would be considered a little high. Okay, and age is kind of an oddball thing to adjust, because if you make one little revision, okay, to the performance or the size, it's going to change the perceived age of that product dramatically. And so even while a product sometimes is moving and you're kind of allowing it to go from the high to the traditional, maybe to the low, if you're doing those things, you still need to sometimes make those little adjustments to make sure that the age is fine. In this case, it's not a problem in the traditional going to the low, because 7.0 or 7.6 or something like that is what the customer is looking for anyhow, so no problem. Okay, so there, I don't mean to pick on Digby, but hopefully give them a little bit of help in figuring out what to do things, right? So they ended up with, what, 2.5 million items, right? And at $30, say, that's 75 million in sales that it cost them. There's the reason for their decrease in sales. And they'll have some work to do to get rid of that inventory, but we'll be at the last practice round. Okay, so back up here then, and we look at some things. ROE jumps out. Look at that. Chester has a higher ROE than Team Erie. Sold $55 million less. Total sales made $10 million less, but had a higher ROE. Well, I hope we've done enough on our assignments to understand why then. Okay, if its profit was $10 million less, intuitively then we should know that its equity is substantially less. So Chester's a smaller company, right? And thus it returns a higher ROE, which as an investor I'm happy about. Okay, we take a look at, so we get some extremes going here on the contribution margin. Look at Team Andrews, generating tons of contribution margin and has a really pretty good SG&A. Okay, I mean, that combination there is pretty darn good. Low SG&A, high contribution margin. So on 137 million, generating 13 millions in profit. That's pretty darned impressive. Okay, Chester's is pretty good too, even lesser on the SG&A. Okay, but not nearly as high on the contribution margin. Erie, as they have been, very impressive again here too, because quite a bit lower on the SG&A, lower than any team but Ferris, and still maintaining good contribution margin. Now we look at Ferris on the other end, other extreme, 19.1%, 4.2%. Okay, this is one of those cases where you look here, and I like to make some guesses that are educated guesses, I would call them, and I would say, looks to me like Ferris might be pricing low, okay, to sell a lot of products. So they're moving a lot of product. They don't then have to spend necessarily a lot on marketing or SG&A, okay, but it also has an adverse effect on its contribution margin, but generating a lot of sales, second best sales, and a reasonable profit, really. Okay, we'll see as we get down and take a look if it is price that's doing that. We see teams still, okay, are looks like Team Ferris is aggressively still unloading stock. Erie hasn't changed, okay, and Team Chester looks like they're kind of aggressively unloading stock. We see a couple downturns. We saw that I think this is the first round where not all the teams made a profit. Baldwin actually showed a loss. It's a rather small loss. Okay, every other team showed a product. Digby had a gain, but it was a very small gain. Bond, you guys don't use a lot of debt. Boy, I look at that and I'm going to say that our leverages are really pretty low, especially for this part of the game. Yeah, those are extremely low. Okay, my cutoff for deducting points for leverage is, I think, 2.2, somewhere around there, or 2.25. Okay, Baldwin, I would say, is extremely low at 1.8, and it's the highest. Okay, so you guys obviously don't believe in leverage in a market sense. Okay, you have to keep in mind that while leverage is somewhat risky, it also generates better returns for the shareholders. Okay, so it's the old risk reward. Okay, and there should be a nice balance there. Okay, you guys are the entire class and seems to be trending towards really low risk. Yeah, that's not all bad, but somebody could take advantage of that. And I see that with look at that, the worst rating here is a double B, which isn't that bad. A's and triple A's, usually at this point in the game we got ratings of C's and worse than that even, because teams are using a lot of leverage actually. So we take a look at our cash flow, and interesting, Baldwin generated, might be a good question as to why they generated a positive there. Okay, Andrew spent some money on plant improvements, but otherwise we're not seeing a ton of money on plant improvements, and I'm frankly astounded by that. Okay, and once again it gets back to what I've said kind of all along. Erie's done well and they're winning, but it's not. No offense, Erie. It's not that Erie isn't playing the game well, but it's that nobody's challenging him. Nobody is pursuing a strategy with vigor. Okay, you guys have all taken kind of a middle of the road, and I know some of you think, oh no, we're being aggressive. Not even close. And leverage is one of those issues, right? Nobody's taken on that kind of risk that you could. Certainly allowable, and certainly has some benefits in terms of reward. Okay, nobody seems to be doing that. You guys are paying off debt. Kind of strange. We do see some buyback of stock. 4 of the 6 teams bought back some stock. Digby, I would say, in both of these cases, if that's the amount, and here we got a sale of common stock and a purchase of common stock, those offset. Okay, and the only thing then that got accomplished there is paying a lot of fees to get that done. Okay, so yeah, and you'd only sell stock if you needed cash, and look at how much cash is available. It's an ungodly amount of cash. Okay, as an investor, I'm incensed. Okay, that my company would have that kind of cash. Okay, sitting on the books that could be used either to pursue the strategy of the company or give it back to me. Okay, as an investor, give that cash back to me so that I can go invest it someplace else. I would be incensed. I'd be writing my board of directors and the manager saying, why would you have so darn much cash? Okay, why don't you give that back to the investors, or at least put it to use? Okay, do something, invest back into the company, etc., etc. Go take a look at Amazon, which has been one of the faster growing companies over the last 5, 6, 8 years. They don't keep a lot of cash. They generate a lot of money. They put it back into the business, and that's the reason Amazon's grown like it has, because they just keep investing money back into the business. The other extreme of that, you look at a company that's a little more mature, like Apple, has close to $200 billion. They might even have over that now in cash. They've been fairly aggressive trying to return some of that to shareholders. And granted, you don't want to be too crazy returning that to shareholders, and so they're trying to balance that. But they, as a shareholder of Apple, I'd want my money, right? Pay it back. Either buy back stock or pay a dividend, so that I, as a shareholder, get the money back if you're not going to use it. And what's Apple going to use $200 billion for? There's probably only 10 or 15 companies in the world that are even worth $200 billion. So every other company Apple could buy and just write a check for without borrowing any money, technically. Okay. What do we see? Did we see big changes in inventory? We see some, and again, we looked at Digby. Remember, we said, they got some inventory, and you can tell that by this number. Ferris a little bit, too. Ferris kind of went crazy in the production side. We saw that in the chart up there. Andrews got rid of some inventory. The other team's kind of, right in there. No huge changes, which is probably good. Okay? We do see Team Chester paid a big dividend too, so quite interesting. Okay, so Chester's trying to get rid of some cash, and that's smart. Remember, going back to the ROE. Okay, one of the reasons they may have a decent ROE. Look at that. They they gave back 11.5 million roughly to the shareholders. Okay, both of these things reduce the equity. Okay, so they reduced their equity by $11.5 million. You see that down here in the total equity. So their equity would have been closer, right at 80 million. Okay, which would have had a decent effect. That would have been what, a 20% effect on their ROE. So their ROE probably would have been closer to 23, 22. So they might not have won the ROE battle if they didn't give this money back to their shareholders. Okay, what's a good amount or a right amount of cash? I don't know. If you could have perfect planning, you'd keep your cash reserves at close to zero, but above, right? I mean, Ferris at 7 million is pretty good, but it would also make me nervous. Okay, so and it kind of depends on the point in the game too. At the very start, yeah, having a nice cushion of 10 million is probably okay. At the very end, I mean, things have grown quite a bit. You might even want a little bigger cushion than 15 or 20 million. Okay, but there's just all boatloads of cash here. 160, 250, $260 million between the 6 teams. That's a boatload of cash. Inventory, again, we saw that with Digby, saw that with Ferris a little bit. That's not a bad total amount of inventory, though, and clearly Andrews, Baldwin, Chester, and Erie have really low amounts of inventory, low amounts of inventory. So land equipment, fixed assets, we see Digby's a small team, and yet Digby has quite a bit more in equity. Isn't that interesting? It's a small team in terms of total fixed assets, but look at the current assets. Okay, and a big part of that, though, however, is in the inventory, which obviously they're going to need to try to dispose of here this next round. So sales, depreciation, do we see any big numbers there? Ferris is obviously, they must have, and they did, they invested. So did Chester, invested in some capacity, if I'm not mistaken. SG&A to sales, you see the numbers aren't that much difference. A low, and remember Ferris had a really low percent. Erie had the highest amount spent, but yet had one of the lower percentages. So again, being very effective. And how do you be effective? Well, again, you pay a lot of attention to the customer buying criteria. Other fees, write-offs. Ooh. Yeah, nobody really, it doesn't look like, took advantage of the TQM. Not to any large degree, but we'll take a look at that. Okay. EBIT, pretty consistent. And we'll have to look at the TQM when we get down there. Interest, we do see Digby's the only team that had a little bit of interest, or Baldwin too. But this is peanuts, compared to what we'd normally see at this time. Okay. So again, the production, we're finally seeing a couple teams, Andrews, Chester, Erie, and Ferris, that are using some capacity. Ferris has. Ferris is using its capacity. Okay, good for them. They're actually getting 2 shifts worth out of it. They're making it. They did have a little bit of inventory here in the low end, but that's it. Okay, Erie had almost no inventory, using a decent amount of capacity. Okay, we see that, yeah, their contribution margin isn't that high, and you might argue that it's because they're using a whole second shift. I'd argue that if you look at their prices are quite a bit lower typically. Just looking in the low end, they're at $19 now. Baldwin's at $18, so a little bit less. Okay, but each of them have pretty low then contribution margins there at 23 and 24%. What else do we got going on in here? So, and again, if you're not using your capacity, you're spending money in places that don't readily show up. You're seeing it in depreciation, you're seeing it in interest, you're seeing it in some other costs. Okay, ROE, it's going to have an adverse effect on your ROE because you got all that extra stuff, which is assets, which positive assets equals positive equity, and so it hurts you there as well. Okay, so there's a nice balance. Well, there is with everything. There's a nice balance of things in terms of equipment, capacity, automation, all those other things, and the assets and everything else on your balance sheet. Sorry, I got distracted there for a second. So come down and look at the. Let's see. We met the demand and sales. Ooh, next year's segment growth rate. Interesting. May want to take a look at that. We don't see a ton of things off here. We do see Digby and Andrews not at all really competing here in the traditional segment. Kind of interesting. Ferris kind of took advantage of other folks not meeting it. They were the big beneficiaries there. Okay, why did Ferris and Cake? Why did they sell the most? Okay, revision date. Fast is up here. Okay, so it's positioned well. It's way up there in the performance. The size coordinates. Okay, price was not the lowest, but pretty low. Okay, MTBF. Yeah, nobody cares about its MTBF. Okay, age is good, right? Spent a decent amount of money on promotion, not all that much money on the sales. That's kind of interesting. Okay, but once again, did it fit the close on the age? 47%, that's a big deal. Okay, decent price, 23%, and ideal position, not too bad. So it took advantage, or it placed itself, okay, pretty good when it comes to that. Okay. Cake was a little younger, spent a little more money. Okay. Low end, met demand, going to have a decrease again next year. Ooh, look at Baldwin. Had a huge potential and didn't meet it. Ooh, Baldwin. Wow. So the question, and I told you this was going to be coming along, is how are we going to calculate its lost profit? Okay, so Baldwin sold 10% of the market, and they could have had about 20%. We'll look at the actual numbers because I'll want the actual. So they could have sold, and roughly, if they sold 10%, they could have sold another 10% or another 1.4 million units. Boy, that would have made a huge difference, right? Okay. Interestingly, look at Dell. Sold pretty well, sold out. Had by far the oldest. Well, age is a big deal, but 7. Okay, so they like older products here, and a lot of these are a lot younger. That's kind of interesting. Okay. Price is, of course, the big thing. So we got 19, 20. Bead didn't do so well, but why is that? Ran out, right? Okay, so Bead only made that many units. Could Bead have made more? Did they have more capacity? I don't know. That's kind of interesting. Let's go take a look. Bead capacity. Oh yeah, they could have made twice because they had 1.5 million in capacity, so they could have made 3 million. So wow. Okay. So missed out on a bunch, and we'll take a look. Honest to goodness, that might have been enough to propel Bead. Let's just do some rough numbers. You guys will have to do some good numbers, but $18, 1.5 million. What the heck's that? 15 plus 12, so $27 million. Profit on that. I don't know what we said that its margin was pretty low, but 25% of that would have been profits. So, 20. So could have made another before tax 7 million probably in profit, somewhere in that neighborhood. Wow. High end didn't meet demand. Look at that. So we didn't meet demand, so we sold out. Erie had a way higher potential. We sold out and didn't meet demand. Andrews sold the most. Okay. 29% market share. Erie must have had two products, right? They do, Echo, and because they had a 37% market share. I was wondering why they had the bigger market share, but they didn't sell as much. Okay, but they had the two products going. So here's the deal on this. Okay, and this is another reason why I say nobody's really pursuing strategy. Nobody's out here where they want this product to be. Okay, the ideal position was 12.5 on the performance side, which would be, let's see here, performance 12.5 would be right about there, somewhere around there, and then 7.5 on the size, which again I'm pretty close. Okay, so there's the ideal position where my cursor's at, if you guys can see that. Okay, everybody else back here. Okay, nobody has pursued, and even though a couple of teams listed differentiation as their strategy, nobody's pursued it. And the same is going to be true down here. Okay, nobody's even come close. Okay, everybody sold out, didn't make enough. We did sell enough here. It looks like there's only two teams really even competing here in the. That's interesting. Wow. They didn't sell out, so they were still selling a few. Okay, but pretty close to selling out. That's kind of interesting, and really only two teams kind of competing there in that size segment. Wow. I'm not going to comment any more on that, about what I would do if I were competing in the size segment. So here we go. Okay, this is going to get really complicated because I'm going to tell you guys, right, I'm going to ask you the question about the profits. So here we go. The potential market share, remember I said for bead was 20.1, 10.2. It actually, though, sold a little bit of Baker. Okay, and it had no potential for Baker. So it kind of made up a little bit. Okay, so in our calculations, that might make it kind of goofy. I might do a two-part question there and say, just bead, how much did it miss out on? But then tell me how Baker affected that. The perceptual map. That's kind of weird. Usually, here in the traditional segment, we'd see a big cluster. Okay, where teams have decided to kind of compete and do their stuff in the traditional segment, and it's kind of scattered, and geez, we got all kinds of teams that are in danger of falling out of the circle even, right? And may have difficulties competing then this next round. That's fine. That may be their strategy. Remember, depending on their strategy, and I think we talked about that. If in fact, like Digby's strategy was to be a life cycle, okay, that's fine. They're letting things kind of go there, but they need to adjust then their sales projections and those types of things based on it. But you also want to take advantage of tactical things. Okay, saw some money now. I see some money now being spent. Here, look at Chester's up to 8.1%, basically productivity. Baldwin made a big jump. Huge savings, right? If you're spending, again, 60, 70, 80 million, okay, and this is going to pay off every year thereafter, 60, 70, 80 million, and you can save 8% basically on those costs. That's $4, $5, $6 million a year henceforth that you're going to save. TQM Andrews did spend some money, okay, on TQM and Erie a little bit too. Here's the numbers down here, okay. You take a look at these, and again, the impact on this, while it's going to be short-lived here in the practice rounds, okay, and they spent a total of $8.5 million, okay. The thing you need to know too about TQM is TQM, unlike automation, say, is an expense. I'll talk about automation maybe in a bit, but it's a direct expense, and so it's kind of a killer, okay, in terms of your profitability maybe for that particular year. But okay, one, you have to remember that it's a tax deductible expense. You get to deduct that. Two, even in the first year, you're getting the benefit of material cost reduction, close to 2%. That's going to be $1 million maybe. 2.5% in labor costs, that's going to be $1 million or a little over $1 million, so you get $2 million back right there. Reduced administrative costs isn't a bunch, a few $100,000. Okay, demand increase of 1%. Wow, so you might get an increased demand and sales then, and that might be $1 million bucks. And reduction in R&D cycle time doesn't really save you a ton of money, but it's going to allow you to move your product further up in your R&D, okay, for less money, which will be huge in the later rounds. Okay, it's also, if you go back, if you'll indulge me, if you come back here to the perceptual map and I tell you that there's nobody that's competing out here, okay, the issue there, if your R&D cycle time, remember, you don't want to make changes that go out more than a year, and so you're going to be limited into how far out you can go here, okay. But if you're reducing that cycle time, you'll be able to go further with the same investment. Okay, so that's it'll be a huge factor, especially for those teams that are competing on differentiation. Okay, may not be as big a deal for a team that's low cost. Okay, so of the $8.5 million in the very first year, you're going to get back a good percentage of that. The rest of it will be tax deductible, and so it's And then the other thing is that investment and these percentages won't change for the rest of the game. So think about that throughout the rest of the game and what your net cost recovery, your time is for cost recovery. It's pretty impressive. So that's pretty much it in terms of taking a look at round 4P. We started to see a little separation here, which I was kind of waiting for. I figured that might happen around 1 or 2 or so, but it didn't. But we're starting to see a little separation. Part of the reason I think, and again I'll say this again, is because nobody's being aggressive. All the teams are kind of hanging back a little bit, and you might look at Erie and say, oh, they had $240 million and $28 million in profits. Not even close to aggressive in terms of pursuing their strategy. So I'll keep repeating that, and the reason I do is because I want to see some teams really figure out, especially when we get into the competitive rounds, really figure out the steps that they can take to pursue a strategy and how to do that without being reckless, but to be really, really aggressive and do it with a lot of rigor. So that's it. I'll quit talking. I've talked longer than I should have anyhow. Thanks, and have a good round.